There's a war going on right now between stock market investors, options traders, and bond traders. And the winner of this war will have serious implications for your accounts. Right now, the NASDAQ rallied on Monday, as I said it would in yesterday's video. We did get a bit of a technical bounce as expected, but once we start to dig a little bit deeper, we begin to realize that the rally wasn't quite as good as it might seem. You see, the Dow and the Russell both fell on Monday, and the only reason that the NASDAQ and the S&P were up was because of technology stocks. And it wasn't even technology stocks across the board. It was really only two. Nvidia rose over 8% on Monday as buyers bought the dip in anticipation of Nvidia reporting better than expected earnings and hopes for the stock to continue to rally post-earnings. The other stock that caused the NASDAQ and S&P to rally on Monday was Tesla, which was up over 7%. Tesla shares rose after a major upgrade from Baird Equity, who added the stock to their best ideas list. Now, it's important to understand that this analyst upgrade does not change the fundamentals or technicals of Tesla whatsoever. Nothing has changed at all with the fundamentals of Tesla. The stock simply rose 7% because of the analyst upgrade. And it's also important to understand that despite today's 7% rally, that Tesla is still down about 20% over the past 3 weeks, and it's still down 44% from its all-time high price of $414. And this is kind of the thing I've been talking about, is that sometimes when you buy a stock that is excessively overvalued, like buying Tesla over $400 a share, it can often take many, many years for you to break even on that stock. Tesla hit $400 a share back in 2021. And here we are in 2023, halfway through, and we have barely just gotten halfway back to that all-time high. And this is the problem, is a lot of times if you buy a stock that's extremely overvalued, like Tesla was over $400 a share, it can take up to 15 years just for you to break even on that purchase. Meaning it could take up to 15 years just for Tesla to get back to $400 per share. Part of the problem that Tesla is dealing with right now fundamentally is that their margins are declining. And Tesla really shot themselves in the foot on margins by cutting the price of their cars in China in half. Tesla has cut the price of their cars in half, knowing that they're going to lose money on every sale of the car. The only reason they're doing it is to try to increase market share. Now, the question is, from bulls, is can the Cybertruck deliveries make up for the losses in China? And that is yet to be seen. We're going to find out in a couple of quarters here, but at least in the short term, probably through the end of the year, the fundamentals are not looking good on Tesla. Now, Tesla has a really good chance of turning things around in Q4 and into 2024 with the launch of their Cybertruck. But in the short term, things are bad. And even after a fall of 44% from all-time highs, Tesla is still trading at an extremely high valuation with a forward PE of 67. Now, keep in mind that forward PEs already include the expected earnings in the future. And because the earnings in the future are already priced in, for the stock to be trading 60 times what it is expected to do in the future, that just shows you how extremely overbought Tesla remains to this day. And for those reasons, it looks like Tesla most likely has more downside before it can truly bottom out and start running up again. The fair valuation on Tesla currently stands at around $70. Now, Tesla's always going to trade at a premium. It'll probably never get down to $70, but that's what the stock is actually worth. Now, Tesla could get back down to $100 a share. It's very, very possible. I've even seen some major Tesla bulls here on YouTube and Rumble and Twitter talk about how Tesla could get down to $100 a share, and these guys are really, really bullish. So investors have to be open for this opportunity. And if Tesla does get down to $100 a share, you've got to be ready to buy the dip and not sit there thinking, oh, well, it's gone down so much, it just might keep going down forever. Stocks don't go down forever. There is definitely a good time to buy the dip. In the same way, the stocks don't go up forever, and you don't want to be buying a stock after it's already had a massive rally, just hoping that it's going to keep going up. And so you didn't want to buy Tesla at 400. You probably don't want to buy it at 200. But if it dips back down to 100 again, it's definitely time to buy the dip. Now, in addition to those two stocks, which caused the stock market to rally on Monday, we also got some earnings that came out Monday as well. Zoom reported earnings Monday after the close, and Zoom beat expectations and lifted their full-year guidance, mainly due to an increase in enterprise business strength. Zoom reported earnings of $1.34 per share versus $1.05 per share expected by analysts. Revenue also came in at a beat at $1.14 billion versus only $1.12 billion expected. And the earnings beat combined with the increase in forward guidance sent Zoom stock up over 4% after hours for a combined gain on the day of nearly 6%. Now, one thing that a rising stock market can help is it can help bring back the IPO market. And the IPO market is often a good indicator of how strong the overall stock market is. And right now, with the stock market generally rising on the year, the IPO market is starting to come back. And we do have another major company that is getting ready to IPO on the NASDAQ. ARM has filed for NASDAQ listing as SoftBank aims to sell its shares in the chip maker. ARM is a chip maker very similar to Intel or AMD or an NVIDIA, but unlike those others, where ARM really shines is in the smartphone market. 99% of smartphones have ARM processors in them. So when it comes to ARM, this is purely a smartphone play. And the strength of ARM is really going to depend upon how many smartphones are sold worldwide. And currently, the smartphone market is down and dropping. So right now, it's not looking good for ARM. But if ARM does IPO relatively soon here, we're not entirely sure when they will IPO, but if they do IPO fairly soon, it might be a good stock to buy because you're buying at the lull of the smartphone market with things expected to turn around in either 2024 or 2025. Now, when it comes to what the stock market is expected to do in the future, it helps to look at market psychology and market sentiment. And currently, the CNN Fear and Greed Index is sitting at 46, which is the bottom end of the neutral stage. And some interesting things about the CNN Fear and Greed Index, when you start digging deeper into the numbers, it shows that bond traders remain quite fearful. It shows that options traders are in extreme fear, and it shows that stock market investors are bullish. So what's going on? Why is it that bond traders have been bearish, options traders over the past week have turned bearish, and yet stock market investors remain bullish? What is essentially going on here is a little bit of a fight between the fundamentals and the market psychology. See, if you look at the fundamentals of the overall economy, they're not good. All signs are pointing to a recession coming. We don't know when that recession will come, but definitely soon. In addition to that, the economy overall is clearly slowing down. Higher interest rates are definitely starting to hurt the economy, and the Fed has already indicated they're going to continue to raise interest rates even higher, which will make any recession we do get that much worse. So the fundamentals of the economy are bad. And anybody that's looking at that is looking at stocks and saying, well, this is going to hurt earnings. And if it hurts earnings, that's going to cause stock prices to go down. And this is one of the reasons why options traders have become so bearish. Now, if you look at the bond market, they're looking at corporate debt, which has the highest delinquency rate since the year 2008, since the great financial crisis. They're looking at company bankruptcies at the highest rate since the 2008 financial crisis. And bond traders are looking at this. They're also looking at banks, which are about to get downgraded again by both Moody's and Fitch. And bond traders are saying, wait a second, we've got some major problems here. things are literally as bad as they were during the 2008 financial crisis in the bond market. So if things are as bad as they were during the 2008 financial crisis and we're about to enter a recession, why are stock market investors still bullish? Well, it really comes down to the psychology of the stock market. So long as people continue to buy stocks for the sake of buying stocks, stocks will either continue to go up or at the very least, they will limit their fall. And that's kind of where we're at right now is investors feel like stocks have just run up like crazy and they're still in this FOMO stage, this fear of missing out, meaning they're not buying stocks because of the fundamentals. If they were, they would realize very quickly that stocks are extremely overvalued. They're not buying stocks because of the technicals, because those are all bearish. They're buying stocks simply because they expect stocks to go up. That's literally the only reason. And they do have good reason for believing that. If you look at the Fed's overnight repo, there's still over $2 trillion sitting on the sidelines waiting to come into the US economy. And that money could very well enter the stock market, which could cause stocks to continue to go up despite the elevated valuations that we're currently at. However, there is another possibility. And the other possibility is that bond traders are right, options traders are right, economists are right, and stock market investors have it wrong. It's possible that we may end up getting a bigger downturn. Now, as I explained in yesterday's video, I don't think we're going to get the downturn this week, at least not until Friday at the earliest. This week, I think we get a little bit of a relief rally. We get that technical rebound that I talked about in yesterday's video. But after this week is when we start to see a little bit more clearly where the stock market might go. Right now, we're still in a pullback. A pullback is just a small downturn in the market, any downturn of less than 10%. And pullbacks are very normal during bull markets. It's nothing to be worried about, nothing to be concerned about at all. There is, outside of the technicals being bearish, there's really nothing that gives me concern that the bull market is ending. This is just a normal pullback. Now, if we got a bigger pullback, say a pullback between 10% and 19%, that would put us into correction territory. And while a correction is more of a significant pullback, it's still normal during bull markets. So even if we do get a correction, even if we do get a downturn of 10 or 15% in the stock market, that still does not take us out of a bull market. The bull market will not end unless the stock market falls 20% or more. And right now, the stock market's only down about 4 or 5%. So I know the past 3 weeks have been painful, but when you think about the fact the market's only down about 4 or 5%, and it's still up about 15% on the year, you start to realize that things really aren't that bad. So yes, we are bullish right now. Stock market investors are bullish. People do believe the stock market will continue to go up, but don't just blindly buy stocks because you just think they're going to go up. Look at the fundamentals, look at the valuations, and make some good determinations. If you look at the stocks I bought on Friday, I'm not buying the stocks that are extremely overvalued like Tesla and Nvidia. I'm buying the stocks that are undervalued, that have not yet run up, that have very little downside risk and major upside possibilities to them. Those are the kinds of stocks I'm buying because those are stocks that are significantly less risky. And by buying those stocks, you know what? I might miss out on some of the massive rallies on some of these tech stocks, but I'm also missing out on the major sell-offs that these tech stocks can very often have as well. And I'm just sitting here, just buying the value stocks, very simple, very easily, not stressing, not worrying. Even if the stock market falls, I'm probably still going to be up because the value stocks just don't have that much room to go down. They're already beat down. So think about that as you're looking at your investment portfolio. Take a look at what you have. If you're very, very heavy into mega cap tech stocks, you might want to consider diversifying a little bit because if we do get a bigger downturn, if options traders and bond traders turn out to be right and the stock market does fall much further from where it is here, those stocks that are overvalued with those PEs of 60 and 80 are going to be the ones that fall the most. So those are the stocks you might want to consider diversifying out of to protect yourself in case of a possible downturn in the market. So far, though, even though the technicals are bearish, stock market investors remain bullish, and with all the money sitting on the sidelines, there's certainly the possibility out there for the stock market to continue its rally after this week. But there are also huge warnings coming out of the economics, the fundamentals, the bond market, and options traders that we do need to keep our eyes on and watch out for. Now, if you want to understand about all these fundamentals and valuations and how to do all this stuff, how to trade, how to buy options so that you can make money no matter which way the stock market goes, I encourage you to go check out my coaching program where I teach you how to do all this stuff. I have classes in there where I go through all of the different ways to do technical analysis, fundamental analysis, trading options, all of that, even market psychology. It's all in the classes. And in addition to that, we have coaches in the coaching program who will help you to learn these topics and help you improve your trades. If you're interested in learning more about that, you can check it out at weprofitdayandnight.com. That's weprofitdayandnight.com. If you get a lot out of this video, be a good friend and share this video with your friends and family so that they will know what's going on in the market as well. Don't forget to hit the like button and subscribe. And if you missed my video yesterday where I explained why the market might rally a little bit this week, make sure you go watch the last video that I uploaded here.